Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Sanjana Prabhakar, Index Research Specialist with Nasdaq Investment Intelligence, to discuss the Nasdaq Q50 Index. It's great to see you as always, Sanjana. Give us an overview of the Nasdaq Q50.
Sure, Jill. So the Nasdaq Q50 tracks companies that are next in line for inclusion into the Nasdaq-100 Index. In our previous trade talks, we have been covering the performance of the Nasdaq-100 this year, where we have highlighted the outperformance of the index driven largely by better than expected tech earnings and the surge in AI. This time, we are pivoting the focus into the Q50, which has been up 9% this year, well below the Nasdaq 100, which has been up 39% this year. And why we are drawing the attention of our viewers to the Q50, we are entering into an environment where the long run for large cap outperformance might slow, and investors who might be worried about rising exposure to a limited number of large caps might be encouraged to look into the Q50.
Let's take a look at your first slide here. Tell us about the index composition.
Sure. So this index consists of 50 companies that are ranked by their market capitalization and includes companies from all major industry groups, including computer hardware and software, telecommunications, biotechnology, and retail. And companies that are included in the Q50, like the companies that are included in the Nasdaq 100, are focused on innovation and growth. And that's something that we wanted to highlight. So if you look at the top 20 names of the index here, you see that they make up about 51% of the index weight. So it's neither overly nor underly concentrated at the top. And some of the top 20 names here, they operate in several industries, including consumer discretionary, consumer staples, technology, healthcare, industrials, and basic materials, so fairly well diversified. It includes the likes of companies such as TradeTalks, Coca-Cola, and MongoDB, each operating in a different industry, which points to the diversification at the top. So just a little bit of color into some of the names here. You have TradeTalks, which is an advertising technology company. You have Coca-Cola with an index weight of 3.3%, a beverage company widely known, makes one of the world's most recognizable brands in beverages. You have MongoDB developing database software for automating monitoring and deployment backpacks. And these top three companies, they actually specialize in one or two areas of technology rather than operating as a large diversified company.
And how has the index performed? What do the returns look like?
Sure. So as I mentioned at the start of the trade talks, this index is up 9% this year. And if you look at the top 20 names, which this chart captures, they registered an average loss of 6.3% in fiscal year 2022, reversing to a gain of 22% on a year-to-date basis. So pretty strong reversal. 13 out of the 20 companies registered losses in 2022. And the gains that you did see accrued to sectors that were relatively insulated from the challenging macroeconomic environment, such as energy. 17 out of the 20 companies have registered gains this year, as the outlook for many of the index's constituents have improved since 2022. And a bit of color into how last year played out. You saw several headwinds by way of weaker pipelines, fluctuation in foreign exchange rates, and a pivot away from unprofitable high growth companies. And this year, these headwinds appear to have largely receded and offset by encouraging outlooks for many of the companies. For example, you have United Airlines, which is forecasting strong profits due to surging international travel. And three of the companies here, First Solar, Steel Dynamics, and Alnylam Pharmaceuticals, registered very strong gains of 72%, 60%, and 40% respectively, sort of bucking the overall trend.
Now, how about if we take a look at longer term performance?
Sure, and this chart is quite interesting. We have tried to capture the performance of the Nasdaq Q50 versus other mid-cap benchmarks and the Nasdaq 100. So as you can see here, and as widely known, the Nasdaq 100 is the relative outperformer. It registered very strong gains of 470% over a 10-year period. The Q50 has also registered strong triple-digit gains of 224% on a price return basis, outperforming other mid-cap benchmarks, including the Russell Mid-Cap, the S&P Mid-Cap 400 Growth Index, and the S&P Mid-Cap 400 Index. And you see pretty strong outperformance outperformance here, largely due to exposure to sectors that were outperforming, such as technology and healthcare. And what I also wanted to point out here is the pandemic was a particularly significant turning point with sudden drops in performance for all indexes. And you can see that in the slide here. Post the lows of the pandemic, you see the pace of recovery deferred. You see the Nasdaq 100 and the Q50 recovering from the lows sooner than other benchmarks. This could possibly reflect the central role played by these companies in the economic recovery. And all four indexes registered declines in 2022. 2023, you see the Nasdaq 100 registering a strong reversal. And you see the mid-cap benchmarks have closely tracked each other, with the Nasdaq Q50 generating returns of 9%.
And finally, let's take a look at sector and industry exposure. Does it have that exposure to tech like we see in the Nasdaq 100?
Yes, it does have a strong exposure to technology, although it's not as heavily concentrated as the Nasdaq 100 in technology. You see the allocation towards technology. You see the total index weight of 31%, followed by consumer discretionary with an index weight of 28% and healthcare with an index weight of 20%. Other differences in sector allocation that are more pronounced include healthcare. As you can see, healthcare accounts for 20% of the total index weight for the Q50, while it accounts for just 6% of the index weight for the Nasdaq 100. You also see basic materials, consumer discretionary, energy, industrials, and utilities have a higher allocation in the Q50 when compared to the Nasdaq 100. So this difference that I just mentioned in sector allocation is quite critical for investors who are looking to gain exposure to innovative companies without being heavily concentrated in technology. And as you can see, in terms of geographic exposure, the Q50 offers exposure to international equities with about 18% of the total index weight allocated to companies. The United States comprises 82% of the index weight. And you see the top two international markets here, Ireland and the United Kingdom, comprising 6% and 5% of the index weight. And as we have highlighted in our trade talks earlier, the last decade was characterized by US equity market dominance. There is a possibility for international markets to outperform over the next decade, and the Q50 presents an opportunity to gain exposure to international markets.
All right, Sanjana, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.